Howdy, Jacob here. Today we're looking at Upbound Group, ticker symbol UPBD. Changed it up a little bit since I couldn't find the company on QuickFS. I'm looking at macro trends. So 10 years ago, revenue was 3.07 billion, and this year we're seeing about 4.24 billion. So a little bit of growth there. We're seeing that it has a 4.54% dividend yield, $1.8 billion market cap, and enterprise value is quite a bit higher. We see cash on hand of just $144 billion and long-term liabilities or long-term debt of $1.4 billion. So we can see that enterprise value is probably close to about $3 billion. So a good amount of net debt here. It looks like on a free cash flow basis, their 5-year average has jumped quite a bit from 5 years ago, but it must be somewhat cyclical. Probably about 200. 1, 2, 3, 4, 5. Okay, so probably about $250 million on a 5-year average basis, and it looks like um, their dividend payout is about 79 million to their 250 million. And 5-year average is under a third, so pretty healthy payout there to get 4.5%. So that's interesting to see. We see that their use of cash flow is they made a huge acquisition last year or in 2021, but otherwise pretty light on the acquisition side. And then they issued debt to fund that acquisition, but otherwise, at least recently, have been paying down debt. So it was kind of tough. You see that they since 2015 were consistently paying down debt, and then to fund this acquisition, they just issued a lot of debt there, which is tough to see. Um, but they also buy back a little bit of shares and um, pay that roughly $80 million in dividends, which is again just about a third. So that's pretty safe, I would say. I'd say that their dividend is safe, but I'm not going to increase. Um, I mean, I guess let's see. Have they increased it? They've increased it pretty consistently the last 2 years, and so I might say because it has grown a little bit, or I'm projecting it to grow a little bit. Let's say 2% increase on dividends. And then on the revenue side, let's say, I mean, it was relatively flat for quite a bit of time, but this acquisition helped bump it up. So maybe 2% on the revenue growth, and then at the end of 10 years, we'll say that there's nearly no growth or not a lot of growth opportunities ahead of them outside of acquisitions, and so we don't see any sort of premium on the price to earnings, price to free cash flow. As for margins, average of 3 and 7. We see that a 2% bump on their long-term debt, let's say 1.4 billion, would be about 28 million, which is very minor in comparison to their $250 million 5-year average. It's just about 10%. So the margin might get hit. The margin might get hit a little bit, but hopefully not too substantially. It is good to see that their free cash flow is so much higher, but their earnings are pretty poor. Pretty poor. I guess it's because they have so much depreciation and amortization that gets bumped back in that they can just write off from GAAP earning due to GAAP, and so I might do 3 and 6% on the margin side, or 3 and 7. I mean, I might bump up the earnings. Let's say that their earnings are come a little bit closer to their free cash flow margin. And then share change, maybe they issue 0.5% or something. It says to reasonable price just needs to fall 30% before we get a 50% return given these assumptions. I feel like as for a dividend, I mean, right now we're looking at a 4.5% dividend yield, and the payout was about a third of 5 year average free cash flow, and so pretty reasonable there. They do have a little bit of debt where you're seeing about a little bit over 5 times their 5 year average free cash flow, but nothing absolutely too concerning from that perspective. I mean, obviously, again, I like to see it probably in like the 2 to 3 range or under. It just obviously depends on the type of business they are, the industry they're in, and their growth opportunities. Like, there's nothing wrong with leveraging a return that you're very confident in. That's going to give you a lot higher rates of return than issuing shares or whatnot. But just right now, I think I'm just waiting for it. But I don't see a reason why it shouldn't be in someone's dividend yield stock portfolio, given the just given that the price is a little bit too high for me right now. I would say that I'm pretty confident in the dividend yield right now, and it looks like the company has had a history of allocating cash towards their dividends. So it's outside of that big acquisition in 2021, we saw that they were pretty consistently paying down that debt, and so that's a positive sign to a company that has about 5 times their 5 year average free cash flow. But I hope everyone enjoyed the video. Researches the company on their own if you want, and has a great rest of the day. So thank you.